Hello and welcome to this Edison audio interview with James Smith, the fund manager of the Miton Global Renewables Trust. Now this is an investment trust that took on its current mandate in the second half of 2020, having previously been more infrastructure focused. It's now wholly focused on renewable energy, and very topical that we're speaking today on Tuesday the 18th of May, the day that the International Energy Agency has published a big report on how to achieve net zero by 2050. So James, hello.
Hi.
Thanks for joining us today. Just to kick off, because this has obviously been in the news lately, to what extent has the new US administration changed the landscape for renewable energy?
It is a big change. From my perspective, quite a welcome change. I think even under Trump, we did still see a lot of renewable energy development in the States. It has its own momentum, irrespective of politics, because of other factors at play, such as costs. The continued fall in production of electricity from renewables means that even without much political involvement, it's still going to see some growth. But yeah, Biden has introduced some new targets, which I think are very positive. So, for instance, he has introduced a target to reduce US greenhouse gas emissions by, I think, 50 to 52% by 2030, compared to 2005 levels. So that's a positive. That was not something that which they had before. And of course, more well known is that they've rejoined the Paris Climate Accord, which of course aims for net zero by 2050. So both those things are very positive. And I think in terms of specific actions that we might see over the next few years, the US has fallen behind in a few areas. So, for instance, in offshore wind, we are far more developed in Europe and even in Asia than they are in the States. And in fact, actually, in the States, there are no commercial scale offshore wind farms as yet. We have one company in the portfolio, Avangrid, which very topical, actually, last week received the final clearance to begin construction of the first commercial scale offshore wind farm in the US. That's the 800 megawatt Vineyard Wind project being sponsored by Avangrid. So that's all a positive, and I think we'll see much faster development in that. And I think the US or Biden has said that they want 30 gigawatts of offshore wind by 2030. So to put that into context, in the UK we want 40 gigawatts. And of course, they have a much larger coastline than us. So 30 gigawatts, I think, is eminently achievable. Of course, in the States, for things like offshore wind, really you're looking at the East Coast because of the depth of the seabed. In the West Coast, the sea is much deeper, so it might take a little longer and be more reliant on technology such as floating wind. So yeah, we're watching that space very carefully. And the other area in the States where I think we'll see more development is in hydrogen production. If we want to fully decarbonize and really replace fossil fuels with a clean alternative, then really hydrogen is the best way to do that. Now, the US has some companies that have good technologies for things like fuel cells, so using hydrogen, but it seems to me they've lagged rather on the companies that have the technology to produce hydrogen, i.e., the companies building electrolysis capacity, which tend to be European. Now, for us, really, as a fund, we play that theme through renewable energy generation. We're not a technology fund by any means, but if hydrogen, is widely adopted, it does mean that there will be a large increase in electricity demand. So that's certainly a positive. So, there's a couple of things we're watching in the US where I expect to see some positive progress over the next few years.
Great, thank you. That's really comprehensive. Now, in the investment trust, investment company space, we've seen quite a few launches this year of funds focused on renewable energy or on energy storage and things like that. Does that increase your investment opportunity set, or does it mean there's more competition for the kind of investments that you're going for?
Yeah, that's an interesting question. We are quite different to those funds. Those funds, well, we are a traditional investment trust in the sense that we are investing in quoted companies listed on recognized stock exchanges around the world. Whereas the companies you're referring to, the funds you're referring to, although they've adopted a closed-end fund structure, either UK or Channel Islands or wherever, their business model is to invest in private projects, which they would tend to own a majority stake, so not listed assets. So in many ways, they are no different from any other company in the way they operate. The only difference is they've adopted a closed-end fund structure, which has, it gives you various effects in terms of how they report, for instance. So they would tend not to consolidate their assets like a normal company would. The actual restrictions placed upon what the company can do is probably a little tighter. So if anything, I see that as increasing our universe, because we can invest in those companies. And in fact, we do actually own a few of them. And in many ways, they are quite useful to us because they tend to be quite defined in what they're doing. So you will have a fund investing in, say, US solar assets, and that's all it will do, or UK battery storage. And again, that's all it will do. So for an investment fund like mine, if for whatever reason we think US solar is a good place to be, then we have a ready-made way to play that theme, as it were.
Great, thank you. So I mean, thinking, still staying with the idea about funds, why might an investor consider an investment in Premier Miton Global Renewables rather than, say, holding a renewable energy exchange traded fund? I mean, people are quite keen on ETFs. What does your fund offer them that they wouldn't get with an ETF?
Well, I should start by saying, the fund is completely agnostic in terms of indices. We don't track an index at all. So, we will differ from the makeup of that index quite markedly. Now, if we look at the main indices, which those ETFs are following, their largest areas of exposure tend to be technology stocks. So companies with fuel cell technologies or hydrogen electrolysis technology, or they might be quite heavily exposed to manufacturing companies, so wind turbine companies, solar panel companies, for instance. While they will have some renewable energy generation exposure, it tends not to make up a significant part of those indices. Where, to be clear, what my investment trust does is predominantly renewable energy generation. So owning hard assets in the ground, producing electricity under long-term regulatory formulas or commercial contracts. So, the underlying exposure is very, very different to the ETFs. Now, if I had to compare, the outcomes, what an investor could expect from my trust as compared to, let's say, the S&P Global Clean Energy Index, which I think is the largest one now in terms of ETFs, because we're not quite so much into technology, the valuations are much lower within the trust, and commensurate with that, we have a higher yield. And also, because of the very long-term contracted nature of the underlying revenue streams of the Global Renewables Trust, I would also say we have a more defensive outlook, a more defensive portfolio than those ETFs. Having said that, renewable energy generation is still growing, so we do still have attractive growth. but I would say, we are lower down on the risk scale than those ETFs. And if we look at the performance over the past few months, since the trust changed its investment objective from infrastructure to renewables, it's coincided actually with those indices having quite a difficult performance period, and we've outperformed them quite nicely. So I think, really demonstrating the more defensive nature of the portfolio.
Okay, well, that's good to know in these uncertain times. And speaking of which, there's been a lot of talk recently about how investors are becoming increasingly worried about rising inflation. Does this affect the renewable energy sector? And is it something you're concerned by?
Yeah, I think it's fair to say that in terms of renewable energy generation assets, the investor perception is that they are very bond-like because of the long-term visibility of revenue and the long-term contracts that tend to be associated with the sector. And in that sense, it's quite similar to utilities. They are, again, often perceived as being quite bond-like or bond proxy companies. However, in reality, it depends on where you are in the world. So it's not a simple answer, unfortunately. If we take the UK, the majority of the revenue earned by UK renewable energy is either through the Renewable Obligation Certificate scheme, which is explicitly index linked, or more recently for offshore wind, for instance, they have what we call contracts for difference, whereby they take a fixed, again, index linked price with the government guaranteeing that price. So renewables in the UK very much index linked. They may have some market exposure, but again, we would expect that power prices may show some correlation with inflation because they are very commodity based. And then we also have quite a number of companies in the portfolio that still have some utility assets. So we call them renewable focused utilities like SSE, for example, or energy networks. So we hold National Grid, and utilities are regulated based on their asset base multiplied by an allowed rate of return. And that asset base is explicitly inflation linked every year. So again, very index linked. And the UK, I should mention, is our largest geographical exposure at the moment, just north of 25%. Elsewhere in the world, it depends. In the US, although renewables may have long-term contracts for, say, 25 years, they tend not to be inflation linked. These are usually arm's length commercial contracts between the renewables project and a buyer. And whether they're inflation linked or not depends on what's been written into that contract. Inflation linkage will be unusual, but they do tend to have annual escalators in there of, say, 2 or 3%. So there you would be on risk for hyperinflation, but you wouldn't necessarily be on risk for modest levels of inflation, such as we expect to see. Elsewhere in the world, it depends. We have a company in Brazil where they sell all their power index linked through the Brazilian energy regulatory system through their long-term auction contracts. And in Europe, it's mixed. Some places it's index linked and some it isn't. But, looking overall at the portfolio, I would say we have, on balance, quite strong inflation linkage as a rule.
Okay, well, that's really interesting. So just staying with the subject of price rises for a minute, you alluded to power prices there. What's the long-term outlook for power prices, and how does this affect the portfolio?
Yeah, this is a big topic at the moment, and it's something that I get asked quite a bit. And if we mentioned earlier some of the investment companies or yield cos that operate in the UK, for instance, and last year we saw them reducing their published net asset values because of a long-term fall in power price assumptions. And we've seen quite poor performance from some of those stocks as a result, which is quite odd, given that if you look at the power price in the UK at the moment, it's currently about £75 a megawatt hour, which is about 60% more than where I would normally expect it to be at this time of year. So power prices in the short term are certainly quite strong, and that's being caused by higher commodity prices, higher gas prices, but also higher carbon prices. So carbon prices have so far this year have gone from just over €30 to about €55 per tonne. And again, that has a direct read through into electricity prices. So longer term, what are the factors that could affect power prices in the UK, for instance? Well, it depends on who you ask. I mean, some people tell me that renewable energy is so cheap that energy, or will be so cheap by then, that electricity will almost be free and the electricity price will collapse. And then other people tell me that renewable energy is hideously expensive and is costing us all a fortune. Well, both of those statements can't be right. And my best guess, really, looking at all the factors, is that we'll be somewhere in between, and that electricity prices should stay fairly well supported. Yes, we will build a lot more renewables in the UK, but on the other side of that, we'll close most of the nuclear capacity over the next 10 years. Carbon prices should continue to go up. And the other angle that's often overlooked is interconnectors. So at the moment, we import about 10% of our electricity consumption from Europe. Now, if the UK power price collapsed to a level below Europe, then that import would turn into an export, and that would be a 20% swing on UK demand. Now, by 2030, I think most people think will be about 15% of our total capacity will be satisfied through interconnectors. So what we'll see, I think, is an increased correlation between UK prices and European prices. And the outlook for European prices is quite strong because they have a lot of coal to come off the system still. And carbon prices keep going up. So I think power prices are fairly well supported. But we'll keep an eye on it. I suppose one extra thing I would add is longer term. We mentioned hydrogen. If we move into this hydrogen economy, the Western world is going to go from a situation where over the past 10 years we've seen a steady fall in electricity demand to a situation whereby we start seeing increases in electricity demand. And that's, I think, quite a seismic shift for the market, because it's not something that we've been used to. We've been used to falling demand, and if suddenly we start have to build more capacity, then again, that should increase rather than decrease electricity prices.
So just coming back to, you said one of the things that your fund does is, versus say an ETF, is it's got quite a good income stream. Now, obviously, a lot of equity strategies have been hit really hard by dividend cuts in the past year or so. What's the outlook for your portfolio?
Yeah, that's a good question. I mean, first of all, some factual stuff on the trust, just to remind people in case they didn't pick this up. But last year, the trust refinanced its zero-dividend preference shares, and we repaid over half of them, which has reduced the size of the portfolio a little. And that de-gearing has meant that our income levels for this year will fall as a result, because the portfolio is slightly smaller. So for us, last year we paid a 10.2 pence dividend for 2020, and the board have said that they expect a dividend level for 2021 of at least 7 pence. Now, having said that, because we have a smaller zero, that difference between the 10 and the 7, investors will get back through a lower finance cost, which is charged through our capital account. So investors net are kind of in are no worse off. But just to say that dividend reduction really has nothing to do with underlying income from the portfolio. And underlying income from the portfolio has continued to be robust. The change from an infrastructure investment objective to a renewable energy investment objective hasn't really changed the income outlook for us in the short term. If in long term, if anything, I think is better because the companies have better growth prospects. But in the short term, the portfolio yield has stayed pretty much constant. Now, having said that, if we look at our dividend growth that we expect over the next 2 or 3 years, I think it'll be underlying growth will be similar to what we've seen over the past couple of years, which is mid to high single digit. Now that range is, if we look at our Chinese shares, for instance, which is about 15% of the portfolio, one of our larger holdings, China Everbright International, their dividend was very strong last year, I think about mid double digits, whereas the others were high single digits. In the UK, a lot of the companies have inflation-linked dividends, so National Grid, for example, and modest, single-digit dividend increases elsewhere. So I think the outlook is fairly robust. We haven't seen companies cutting their dividends in the way that other sectors have. And again, as you mentioned, that really is a feature of, well, I suppose two things. Firstly, that the sector has largely contracted its power price risk. And secondly, that renewable energy tends to be what we call a priority offtake for the grid. So, if the wind is blowing, your wind farm is selling that power. And the grid doesn't say, well, we don't need your power because demand has fallen. Because it has zero marginal cost, it doesn't produce any pollution. Grids will take power from renewables in preference to fossil fuel generators. So last year, for instance, output from renewables continued to increase, and the fall in electricity demand that we saw across the world, not just in the UK, that was met by falls in output from thermal generation rather than renewables. So, you're kind of decoupled from GDP type risks in that sense.
Well, thank you very much, James. That's been a really useful and interesting roundup. So you've been listening to this Edison audio with James Smith from Premier Miton Global Renewables. I'm Sarah Godfrey, a director in Edison's investment companies team. James, thank you very much.
Thanks, Sarah.